Should you invest your money over time, what's known as dollar cost averaging, or should you put all of your cash at once in the stock market, what's also known as a lump sum investment? In today's video, we're going to take a look at dollar cost averaging as an investment strategy and whether it provides higher returns compared to the lump sum approach. As usual, there are multiple variables to consider and the answer will differ from person to person. But I'm going to take a look at 3 specific areas which I believe you should consider when you're trying to decide to dollar cost average or not. Number 1, what has done better statistically? Speaking from a pure statistical standpoint, what gives us the better return? Dollar cost averaging or the lump sum investment? Number 2, what has done better historically? And I want to take a look at the good times and the bad times. Number 3, what is better from a behavioral or emotional standpoint? As we know, emotions are our worst enemy when it comes to investing. So that being said, let's dig deeper into those 3 considerations and see what's better. Welcome to another episode of Investing with Kurt. Today we're looking at dollar cost averaging and whether that is better than simply going all in or investing a lump sum at once. First of all, let's define what is dollar cost averaging. In case you're new to investing and you're not familiar with the term, let's define it. So dollar cost averaging, often abbreviated as DCA, is an investment strategy or approach in which an investor divides up the total amount to be invested across periodic purchases of target assets. In our case, those are basically stocks. And that is in an effort to reduce the impact of volatility of the overall purchase. Dollar cost averaging is an approach an investor can use to build savings and wealth over a long period. It is also a way for an investor to neutralize short-term volatility in the market. Let me give you a practical example. Let's say you receive a paycheck of $1,000 every 2 weeks, or your salary is $2,000 a month. If you follow the rule of thumb to pay yourself first and save 10% of your paycheck and put that aside for investment, that is $100 every paycheck. So to make this even simpler, let's assume you're to invest only in one index fund, something like the S&P 500 index. So every 2 weeks, you'll be putting those $100 and buying S&P 500 shares. With that predefined amount, you'll be able to purchase more shares when the market is down or less shares when the market is up. You simply continue investing the same dollar amount, thus the term dollar cost averaging. Now, there is a common question amongst investors, what is better, to dollar cost average or to invest a lump sum at once? To answer that question, I'll give you 3 aspects or 3 arguments to look at and determine what is right for you. The first aspect is, what is the statistical probability? From a statistical standpoint, what's going to give you the better returns? Is it the dollar cost averaging or the lump sum? Statistics show that you're likely to make more money if you invest your money as a lump sum rather than putting it in gradually in equal amounts while dollar cost averaging for several months, for example. Now, Vanguard has done a great study and published a paper titled "Dollar Cost Averaging Just Means Taking Risk Later." Let's take a closer look at the study. In the paper, they say the following. On average, we find that LSI approach, this is the abbreviation for lump sum investment, has outperformed a dollar cost averaging approach approximately 2/3 of the time. This finding is consistent with the fact that the returns of stocks and bonds exceed that of cash over a study period in each of these markets. So the study was done with data for the United States, UK, and Australia. In the research, they even break it down how this varies by country. Surprisingly, there was no difference between the United States and UK. They both showed higher returns of lump sum versus dollar cost averaging in the amount of 67% of the time. So the numbers for Australia were 66% in favor of lump sum versus DCA, so a negligible difference. Notice that the data that was used for this research spanned across many years. For the US, the data was between 1926 to 2011. For UK, we're looking at a period of 1976 to 2011, and for Australia, it was the kind of like the smallest data set, but still dating back to 1984. So those were definitely large periods of time and good amount of data to really derive these findings. What's also interesting is that the percentages did not differ that much depending on whether you have an old stock portfolio or a mix of stocks and bonds, or even just bonds. Lump sum investment still beat dollar cost averaging. So in other words, if you think that dollar cost averaging is a way to minimize risks to go in the market at the wrong time and spread out your risk in your investments, 2/3 of the time you're actually setting yourself for lower returns. This is why Vanguard actually titled the paper, "Dollar cost averaging only delays the risk, does not eliminate it." In fact, it introduces an opportunity cost for you. Let's take a look at the second aspect or argument that you should consider. How does dollar cost averaging versus lump sum investment do during recessions such as the Great Depression or any other black swan event of sort? If you invested a lump sum in 1921, at a certain point in time you were down more than 75%. Only around 1937 you were able to get to what you put in almost 8 or 9 years ago, and that was if you didn't get out of the market despite what was happening. So that particular duration of 9 or 10 years during the Great Depression, it was very, very challenging, and actually if you use the lump sum approach, it was very difficult and you actually lost money. Within 10 years, you barely broke even. So if you invested $20,000 in the beginning of 1929, you lost $15,000 by 1932. So just again, in a matter of 2.5 years, you lost most of your money. By the end of 1929, you lost about 30%. In 1930, the market was down 24%. 1931, even more. So 1932, your portfolio was down 75% from where you started. So you had to go through a lot of negative years during that almost 10-year span, and it was emotionally very, very difficult. A lump sum did not pan out, as you couldn't even break even after all those years. Now, if we're dollar cost averaging during that same period and say you put $1,000 every 2 months, you would have made 32% cumulatively for the 10-year period. Not a great return for 10 years, but a lot better than losing money if you invested the lump sum. At some point, your 20K grew, up to $37,000 in 1937, but there were some more hiccups after that. And in that particular case, dollar cost averaging was a significantly better approach compared to lump sum investment. So, if we draw a parallel between what happened back then and what we're facing now with the global disease, what should we do? Experts say some things are similar to 1929, things like the unemployment rate, etc. is very high, but then the circumstances are different and it is unlikely that the same thing will happen today. Nevertheless, if you're risk averse, dollar cost averaging might be a better option for you. In fact, dollar cost averaging into a downward market is the best time to actually dollar cost average in a way. The third aspect that we need to look at when we're considering dollar cost averaging versus lump sum investment is what would work best for us emotionally. Investing decisions are ruled by our emotions, and unfortunately, they do not play in our favor. So it is important to consider your risk tolerance when you're deciding to dollar cost average or not. It may be that as you had this money sitting in cash or in your savings account or CDs for some time, maybe putting that money in the market all at once is more risk that you can emotionally handle. So you may think you can handle the risk, but emotionally it may be very, very difficult for you. Especially if you're a first-time investor, you don't know how you're actually going to react emotionally to market downtrends. So, assuming that you would not need this money for 5 years or longer, as we saw earlier, lump sum generally outperforms dollar cost averaging, but it doesn't take into account if you will be able to emotionally withstand should the market go down. When deciding between investing all your money now, lump sum, or over time, dollar cost averaging, it is almost always better to invest it now, even on a risk-adjusted basis. This is true across asset classes, time periods, and nearly all valuation regimes. Generally, the longer you wait to deploy your cash, the worse off you will be. In rare occasions, dollar cost averaging might prove better, and as we just saw in 1929, dollar cost averaging is a great approach when averaging into a falling market. Now, what is the alternative? When you don't like neither lump sum or dollar cost averaging, compromise by doing 50-50. You can invest 50% of your money in a lump sum now and invest the rest over time, say in the next 6 to 12 months. This is much better than staying on the sidelines and not investing. Alright, thank you guys for watching. I hope you learned something new today on investing. If you enjoyed the video, make sure to destroy the like button, and as usual, if I missed anything, drop it down in the comment section below. And if you're new here, please subscribe for more videos and real investing advice. Check out some of my other videos from my investing playlist where I talk about the most important topics and teach you what to do. So, until next time, stay the course and keep investing on a regular basis.